Good day, friends. We have a brand new amazing video on when is the best time to invest in crypto for you today. Therefore, like the video and subscribe to our YouTube channel before it starts to see more. The price of cryptocurrencies like Bitcoin can fluctuate daily or even hourly. Volatility, like any type of investment, can lead to uncertainty, FOMO, fear of missing out, or even dread of participation altogether. How do you determine when to buy while prices are fluctuating? It's straightforward. In an ideal world, buy low, sell high. Even for specialists, this is easier said than done. Dollar cost averaging, sometimes known as DCA, is a method employed by many investors to lessen the effects of market volatility by routinely investing a lesser sum into an asset, such as stocks, gold, or cryptocurrencies, as opposed to trying to time the market. When someone believes their investments will improve in value over the long run and encounter price volatility along the way, DCA may be the best option. Describe DCA. Using the DCA method, an investor routinely purchases smaller amounts of an asset over time, regardless of price. For instance, investing $100 in Bitcoin each month for a year as opposed to $1,200 all at once. Depending on their aims, their DCA schedule may evolve and persist for a short while or a long period. Although DCA is a well-liked method of purchasing Bitcoin, this method of coping with stock market volatility has been employed by traditional investors for decades. If you regularly invest through your employer's retirement plan, you might be using DCA already. What advantages does DCA offer? Without the famously tough task of timing the market or the danger of unintentionally squandering all of your money to invest a lump sum at the top, DCA can be a useful approach to owning cryptocurrency. No matter how expensive an item is, the goal is to routinely invest a manageable amount. This may average out the price of purchases over time and lessen the overall effect of a sharp decrease in costs on any particular purchase. And even if prices do drop, DCA investors can still buy as planned with the chance to profit when they rise. When is DCA more beneficial than investing a lump sum? An investor can enter a market safely with the aid of DCA, begin to profit from long-term price growth, and balance off the danger of short-term price declines. And in circumstances like the ones listed below, it might provide more predictable profits compared to making a large investment all at once, purchasing a product whose value might rise in the future. An investor can utilize DCA to invest money during the period they believe a downward movement will occur if they believe prices are poised to decline but are likely to recover in the long run. If they're right, they'll gain from being able to purchase assets for less money. However, even if they are mistaken, they will still have market investments as the price rises. Betting with volatility as a hedge. Investors are exposed to prices over time through DCA. This technique seeks to balance out any sharp increases or declines in portfolio value during periods of price volatility while also profiting modestly from price movement in all directions. Avoiding emotional trading and FOMO. DCA is a method of investing that is based on rules. Beginner traders sometimes fall victim to emotional trading, in which decisions about whether to purchase and sell are influenced by emotions like fear or enthusiasm. Investors may handle their investments ineffectively as a result of these. Think, panic selling during a downturn or overbetting due to fear of missing out on exponential growth. How does DCA function in real life? Any DCA strategy's success is, of course, still dependent on market conditions. Let's examine a real-world price example to illustrate this as Bitcoin was about to see its greatest decline to date. Starting on December 18, 2017, around the price peak of that year, you might have invested $100 in Bitcoin each week for a total of $16,300. However, your portfolio would be worth almost $65,000 on January 25, 2021. Representing a return on investment of more than 299%. Here are some things to consider before entering this high-risk, high-reward industry. Number 1. Avoid placing large bets. The incredible returns provided by various cryptocurrencies over the last year are mouth-watering. A 6-month-old investment of 10,000 rupees in Dogecoin is now worth 5 rupees 75 lakh. But don't let these figures fool you. Vineet Nanda, a co-founder of Globalize, advises investors to only invest money they are prepared to lose. Even if you enjoy taking on a lot of danger, start modest. According to Vikram Subburaj, CEO of the Giatus cryptocurrency exchange, don't invest more than 2% of your total capital in cryptocurrencies. Before allocating further funds, read up on different coins and gain an understanding of their value and future possibilities after becoming familiar with the arena. Number 2. Prepare for heightened volatility. The greatest way to educate yourself on cryptocurrencies is to invest in them. However, it is a game of high risk and huge returns, therefore you must be able to handle extremely high volatility. A decline of between 70% and 80% overnight is also conceivable, as the May crash demonstrated. Remember that even a blue chip like Bitcoin has lost 48% of its value since reaching a high in April of 50 rupees lakh. According to Praveen Bajpai, founder of FinFix Research and Analytics, enter this market only if you can handle severe volatility and the ramifications of an investment going wrong. Number 3. Select a reliable platform. In India, the cryptocurrency industry is unregulated, and new businesses are sprouting up daily. Although the Supreme Court overturned the RBI's ban on cryptocurrencies, and the government has indicated that it will regulate the sector with a measured approach, investors must exercise caution when selecting the intermediary. Remember that investing through an international platform can necessitate poor stringent tax compliance. Number 4. Verify all tips before acting on them. There is a severe paucity of reliable information in the crypto realm. Investors rely heavily on unreliable information found on social media. Self-proclaimed crypto analysts establish WhatsApp groups filled with allies who attest to their accuracy. These experts use naive investors as bait for their pump-and-dump schemes by first asking a charge for the suggestions. Raj Khosla, managing director of MyMoneyMantra.com, advises that you should generally confirm the information before investing. Number 5. Concentrate on blue chips. The cryptocurrency market features blue chips, mid-caps, and penny coins just like the stock markets do. Avoid giving in to the temptation to purchase rare coins just because you can acquire a lot of them for a cheap price. Although more expensive, larger coins are more reliable. Whatever the case, you can purchase in smaller amounts, so don't worry about the cost. The leading cryptocurrency is Bitcoin, which determines the mood of the market as a whole. According to Gaurav Garg, head of research at Capital Via, concentrate on the blue-chip currencies like Bitcoin and Ethereum, with some of your money in new counters like Dogecoin and Matic. Number 6. Stay current with world events. Even though you may be buying and selling in India, the cryptocurrency market is global. Any worldwide development has the potential to affect pricing. So it is important to keep up with what's going on in important markets like the US, Singapore, and Europe. Manish P. Hanger, the founder of Fintan, notes that the crypto tax in the US was one of the reasons why cryptocurrencies fell in price in May. An informed investor will avoid making a mistake. The fact that cryptocurrency trading is available around the clock means that one can act right away, in contrast to stock markets where one must wait for a trade to begin the next day. Number 7. Pay attention to the tax. Last but not least, pay attention to the tax due on your cryptocurrency trading profits. According to the CEO of tax filing website ClearTax Archit Gupta, even if cryptocurrencies are not specifically mentioned in the income tax legislation, income in any form from any source is taxable unless specifically exempted under the Act. Since the RBI does not classify cryptocurrencies as currency, they must be handled as capital assets. According to Homi Mistry, partner at Deloitte India, there is no court precedent, but it may be presumed that cryptos will be recognized as capital assets. This means that while long-term gains will be subject to a 20% post-indexation tax, short-term gains will be added to income and taxed at regular rates. How was this video? Do you like it? Give your precious response in our comment section. Also subscribe to our channel.